Hey everyone, and welcome to another Mortgage Minute Live. I'm Garrett Finkelstein, and we are here today to map out and navigate the road ahead with current housing market insights, trends, and even some new products. Today I'm here with Benchmark COO and TMBA President Steve Remington. Thanks for joining us.
Yeah, glad to be here. Good to see you.
Awesome. So, hey, today we're going to just jump right into it. Why don't you hit the first road sign in our current market?
Yeah, so topic number one today is we're talking about the housing market. So the market is rebalancing. More sellers are accepting offers lower than their list price last month. So in August, we saw a list to sell price of 99%, down 1% from the prior month. So, but if you look a couple months back, we were at 101% in July, 104% in April. So you can kind of see the shift in those numbers, a little bit of a correction. So as a result, August sales were 5.3% higher than July. So we saw a little bottoming in July, a little bit of uptick in August. It seems like it's pretty healthy. The median sale price declined by 2.4% to $410,000 after hitting $426,000 just 3 months ago. So you can see that shift. Like we've hit that kind of peak. Yeah. Sellers have reset expectations. Affordability is a challenge right now. So it seems like a move in the right direction. Other data, the number of homes for sale went up by 20% in August. So we're starting to see inventory. We talked about not having inventory for how many years? Yeah. So we needed that shift. And then other data, housing starts was released yesterday. Saw a little bit of a rebound. Some of that's a little mixed with some multifamily and some residential, but it's still a positive news. Permits were down a little bit, so you can see that builder pullback. But that's your housing market data.
Perfect. And it seems like every time I'm on here, we're talking about something the Fed is up to.
Yeah.
They've got a big meeting or a big announcement today. Why don't you talk a little bit about that?
So today's day 2 of their 2-day FOMC meeting. They meet every 6 weeks. We had a little bit of a break here in August. We didn't have a meeting. They had their Jackson Hole summit. And so there was some data happening. There was some feedback there. But today's meeting wraps at 1 p.m. Central, 2 p.m. Eastern time. So you need to tune in and watch. The market has already priced in a 75 basis point increase in Fed funds. There has been some talk about 100 basis points. So if it was 100, it wouldn't be the end of the world because some of the market's anticipating that. But what does that mean for you? That's been priced in for a while now. You're seeing that reflected in your mortgage pricing today. Everything's pricing in kind of a worst case scenario. So when you dig deeper into that data, 30 minutes after the announcement, they'll have a press conference, and you just need to listen to the tone of Chair Powell in his answers. Are they going to take a wait and see approach, more a dovish approach in November and watch the data very carefully, or they have this really adamant hawkish stance where they're saying, no, we're going to continue to be aggressive, buckle up your seatbelts and get on for the ride. So that's your Fed watch on the FOMC.
Perfect. And so, look, as if we don't want to just talk about the Fed the whole entire time, a little bit more data is coming out in terms of things that they're doing with their balance sheet. Talk a little bit about that.
Yeah, so two of the Fed's tools, or really their only tools, are the federal funds rate, how they can adjust the rate to adjust the market, or they have their balance sheet. They can deploy capital like quantitative easing. You can see on the graph here in 2020 and 2021, they were purchasing a big chunk of the mortgage-backed security production, but they stopped that a few months ago. But they have been reinvesting the runoff. So as loans pay off, as loans amortize, that balance of those mortgage-backed securities comes down a little bit, and they were simply redeploying that cash into buying some incremental MBS. But that is officially stopped this week. Perfect. And so the market is going to take a minute to adjust to it. We knew this was going to happen. They were only buying a small percentage of the total production of mortgage-backed securities the last few months. So I don't expect a lot of ripples from that, but it's just knowing that that's there. The next step would be the Fed to start selling the mortgage-backed securities from their balance sheet into the open market. That could change things up in the dynamic a little bit, but they don't want to do that today when they're trying to raise rates and stop inflation. So just know that that's coming.
Cool. And so look, thanks for those bullet points. Hey, video man in the back, why don't you go and hit the next segment is Steve's keys. Why don't we hit a couple of your keys today?
Yeah. So first key today is we're officially in a buyer's market. Make sure when you're talking to your referral partners, whether your builders, your real estate agents, and make sure that everybody understands, look, there are tools to arm that seller with the proper way to list that home to be desirable to a buyer. Maybe they're offering interest rate buy downs or paying discount points or incentives. That's just a shift. That's maybe that 2 or 3 or 4% shift in price to those incentives might be enticing to a buyer to offset higher interest rates. But really it's just sellers have changed their behavior to align with the current economic conditions.
Next up,
tune in at 1 p.m. Central, 2 p.m. Eastern time to the announcement. It's a very brief one-pager. They announce immediately what the rate increase is to the Fed funds rate, but then 30 minutes later, listen to that press conference, listen to the tone, listen to the question and answer. It's about a 20 or 30-minute press conference, but you'll learn a lot about the insight about what the Fed is looking at next.
Yep, perfect. And your last key of the day?
The reality of the market and the industry are cyclical. So we go through these waves every 5 to 8 to 11 years. There's something that shifts. Like a couple years ago, it was the pandemic hit and we had this refi boom. The Fed deployed all this capital. You go back to 2018, we had a dip and then the Fed had to tighten. You go back to 2008 and 9 with the meltdown, the credit crisis. These usually are not long-lived, but they are painful. Everybody's going through pain right now. Buyers are having challenges with affordability. Sellers are now having to reset baselines on pricing. Rates are higher, and so the Fed is trying to cool off the economy. It seems like it's starting. You've seen those CPI numbers showing that inflection point. We just need that to continue. But once we see inflation curb, the Fed should cool their jets a little bit. Things will kind of stabilize, and we'll be able to figure out the horizon.
Awesome. Well, hey, thank you all for joining us again on another Mortgage Minute Live.